All right, so the unfair advantage that makes me millions trading. I've been trading for 7 years. 5 of those have been profitable, and I've made millions of dollars trading stocks, forex, and crypto over these past 5 years. And I'll tell you what the secret is right now, because it's really not a secret, but this is my unfair advantage. I keep things really, 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 really simple. That's it. I don't consider myself a very smart person. Smart enough to trade, yeah, but I might be a lot like you. You might not consider yourself a smart person. And I'm not calling you stupid. If anything, I'm calling myself stupid here because really, I don't know how I figured out Forex trading or anything. Some people have all these crazy things they do, this market maker, bank manipulation, fair value gap, distribution, order block, accumulation, Wagyu beef, bullish candlestick strategy that quite frankly, I just don't understand. I've done the bare minimum the past 5 years of my profitability, and I actually got profitable by doing way less than all this system hopping and shiny object syndrome jumping around trying to do different things. Simplicity is my unfair advantage that has made me millions of dollars trading the past few years. So you can go ahead and click off this video. Just go keep things simple if you want. You don't even have to watch the rest of the video. I'm going to show you exactly what my system is and literally show you trades I'm in right now and show you how you can duplicate this. I cannot guarantee you anything. Trading's risky. You shouldn't be trading at all. You're probably going to lose all your money because most traders lose money. You shouldn't listen to anything I say. I'm just some idiot yelling at you here in a YouTube video. And let's go ahead and go. I'm going to share my screen. I'm going to make my little zoom tile nice and big so that we can just really get nice, close, and intimate here. Let me show you 2 trades I've taken literally today using my simple approach. So I took a trade here on GBP JPY, and I sold at a resistance zone. Price is at a daily resistance. I sold, and now prices bounced down a little bit. So that's the first trade. Second trade is I took a CAD CHF trade, and I took this because price broke a support zone, came and tested it, and then I just sold. And that was it. Now you may be wondering, well, Nick, what's your system like? What's all the nuances? What's this and that? So there's a lot of experience that goes into it, but essentially here's all it is. There are support zones and there are resistance zones, and that's all I use in trading. I literally don't use anything else. Whenever price gets to a major support zone on the higher time frames, daily chart is the chart that I stay on most of the time, I buy when price gets down there to the support. So we'll illustrate this using a beautiful little lovely right directional arrow. Will be super high production quality here in this video today using an arrow to represent the buy position. And then if price gets to a resistance zone, a super clear resistance zone on the daily chart, I just sell. That's it. This is literally all I do. Now I have a specific risk structure for if I'm wrong, I'm still able to make money or at least break even a lot of the time on my trades that don't work out. And the other half the time it bounces at the zone, the trade goes right into profit and it's a win. So what I'm going to be doing is I'm going to show you, for one here in this video, exactly how you can take this same simple approach and start applying it literally today. After this video, for freak's sake, finish the video first. That way you actually know how to do this. Then after this video, you can go and you can start applying this stuff literally immediately afterwards. And it only takes like 15 minutes a day. It's really not complicated at all. I trade full time, so I mean, I've got a little bit longer to spend than 15 minutes a day. Otherwise, I'd probably get bored playing Age of Empires 4 all day. But that's not the important part here. The important part here is to keep it super, super simple. So let's keep it simple, in fact, and let's go here and let me give you a little proof of concept here. The first link in the description is the link to my free Telegram channel where literally you can follow me sharing all of my trades and analysis daily for free. And I've been doing it for the past 5 years. I put my money where my mouth is and I literally show people the same stuff that I actually do on a daily basis. I show all my win streaks. I show all my losing streaks. I show all the ups and downs. And I've been doing this for 5 years, and you can follow it at that first link in the description. You can follow all my daily trades and analysis. It's literally just support and resistance zones. That is all I do. It's just support and resistance. So let me show you exactly how this all works. And I'm going to show you this in like a TradingView replay mode. That way we can all get a proof of concept here. We can keep it nice and simple. TradingView replay mode it's not like totally realistic, but it's good enough to help generate a proof of concept so that you can learn this stuff. So we've got the number 4 here. So let's select 4 pairs down. 1, 2, 3, 4. USD CHF. Sweet. So we're going to go here to USD CHF. And what we will do is we will go clear all the drawings and we will scroll back to a random portion on the daily chart. And then we will click the little replay tool here. So Here's all I do. It takes me like probably 15 seconds to analyze a currency pair. And by the time you get to the end of this video, it'll take you probably like 15 seconds or less. I can't guarantee you anything, but I'm just saying, like, if unless you're literally a complete idiot, unless you're somehow stupider than me, which I mean, not many people are stupider than me, I feel, but maybe I'm just crazy here. Unless you're stupider than me, it's really not that complicated. It really doesn't take that much time because you literally do the bare minimum, and there are so few things to screw up. It's just that simple. So let me show you. All I do is I go to a chart, I look at where the current market price is, I draw the next major resistance zone above price and the next major support zone below price. Areas where the market has had nice bounces from. I don't do any crap like this where price kind of goes in and out of a zone and it's kind of too thin and it kind of bounces around multiple times. I don't do any of that. I just use the major ones. That's all I'm interested in. I don't care about anything else. That's all. And you got 26 Forex majors and more exotics and crosses that you can look at, but 26 major pairs that you can look at to find just support resistance zones. You're only going to get a couple trades a week, but you barely have to do anything. And I'll show you how this works. So here is what I will do. If price gets to this support zone, I will buy right there. And if price gets to this resistance zone, I will sell right there. Now, one of these things is going to happen because price is probably not going to go sideways forever. So I'll go ahead and throw these little arrow things in the chart. That way you can literally see like where the orders would already be. If price gets to the resistance zone and it breaks past it, what I will do is I will hedge. What hedging is where you enter an equal and opposite position size. So if I sell right here at one lot, I'll just buy at one lot if it goes past the zone. I don't typically like using stop losses. Sometimes I'll use them if a trade starts going into profit or in certain contextual situations, but it's mainly just price goes to support, I buy, price goes to resistance, I sell. So let's see if price is going to go up or down. So it goes sideways, you do nothing, it gets to the resistance, and here's what I do. I would sell as soon as it gets there. Now, we got to figure out what the risk would be because there's one of two things that can happen, right? It goes up through the resistance zone or it goes down. And if it goes down, we'll make some money. And if it goes up, we'll lose some money. But in this case, we really won't even lose money because I'll show you how. So here's what I'll do. I will set the thing called an invalidation zone just above this zone. And what this means is that if price goes to that invalidation zone, it's exactly where most people will put a stop loss. That's it. Except instead of a stop loss, I just put a buy order. So it's a pending buy hedge order. And sometimes I'll do pending, sometimes I'll just do an alert and then I'll manually do it right there. Sometimes I'll close the trade at a loss if I don't think I should be hedging or something. It all just kind of depends on the situation. But in most cases, price breaks the zone, I'll just get hedged and then that'll just lock in the loss. So that way, no matter where price goes, it'll just stay the same floating loss. And then I'll simply wait for the next zone. Now, price is likely to bounce 50% of the time at any one of these zones. And that's complete random chance. On some weeks, I'm better. On some weeks, I'm worse. But it averages out to like 50% long term. Price just goes up or it goes down. It's 50-50. You don't have to predict the market or be a god to make money. You just have to control risk and structure it appropriately and keep things so dirt simple that it's the same consistent thing over and over. You barely have to do anything. So now that I've sold here, let's say I'm risking $1,000 and price goes up to here, and that's $1,000 risk. So I'd calculate the lot size and everything, and if it moves down, an equal distance, it'll be $1,000 profit. So we'll see what happens here. So price goes down, and let's say that's a little more than a 1-to-1, so this one happened to be a winner. So cool. So it's a winning trade. Let's say for 74 pips, so like right about there, because 74 pips was the distance for the invalidation. So if we risked $1,000 on this, we have now made $1,000. And what did we do? We drew a little horizontal gray shaded rectangle. And then when price got to that area, we entered a trade and we just planned the risk out. We said, if it gets above, this is how much risk I want to have. $100 risk, $1,000 risk, $5,000 risk, whatever it is you want to risk per trade. And then if it goes down, about a 1-to-1 risk reward ratio, I just close in profit. Sometimes I'll hold longer. It kind of depends on the situation. For the sake of simplicity, 1-to-1 risk reward ratio works fine. Doesn't matter what your previous gurus have told you. Doesn't matter anyone telling you that you need a 1-to-69 risk reward ratio to trade profitably. None of that matters. All that matters is that you have a decent win rate, at least 50-50. I mean, at least random chance. And then you have a clear risk structure for what to do in case you're wrong. Because if you're right, it's easy. You're right half the time without even trying. And the other half the time you're wrong, you have to manage the trade. So let's go ahead and get ourselves into another trade here. And we'll just wait for price to get to one of these zones again, and then we'll tally up everything. And I'll go ahead and pull up like a Google calculator here. We'll say that we started, I don't know, like a $10,000 little account, and then we've made we won one trade, so we've won $1,000. So we'll keep it at that. So we're at $11,000 now. We'll try to grow this to like 15K, just to give you guys a little proof of concept here to show you guys everything. So now we'll just wait for price to get to one of these zones again. So now price comes down here to this support zone. So if price gets into this support zone, so a little bit deeper, normally about halfway for me, then I will buy as soon as it gets there. And if I'm wrong, I'm not going to stop out on this trade. I'm going to enter a sell at an equal and opposite position size. So if this is like a 0.69 lot size, wink, wink, it'll be a 0.69 lot size sell. So if you're in a buy for 0.69 and it goes down, and that represents, let's say, $1,000 risk, for example, it'll enter you to a sell. Now you're what's called hedged. You're in an equal buy and an equal sell, and then the loss does not go up or down. It just stays the same. And this just allows you to default on the loss till the next trading opportunity, then roll out of the loss into a profit. I'll show you exactly how it works once we finally have a losing trade. So if price can come a little bit deeper into this zone, right there, so perfect. So now we're into a buy. Now, keep in mind, one of two things are going to happen. It's going to go up, and if we're in about a 1-to-1 risk reward, we'll make a profit. Or it's going to go down, and we're going to get hedged at a $1,000 loss. Okay? So let's play it. So it pushes down and it gets us hedged. So perfect. We finally have a losing trade after the first one. Like I said, 50-50. We won the first one. Now we've lost the second one. So here's what I do whenever I get hedged. Super simple. I just wait for the next zone. Now what do? I just restart the same analysis routine. I look at current market price. I try to find one zone above price and one zone below price. And then I just set an alert, and then I wait for the market to get there. So where would the next zone be? It looks like we had a little bit of a resistance zone right there. So let me just draw that resistance zone in here. And then once price gets there, we'll have a way that we can manage this trade. Now, when zones bounce at a 50-50 chance, it means that if price comes down into this zone, there's like a 50-50 chance that it might bounce there and just go back up. That would be cool if it went back up. That would be very, very nice if it went back up. And if it goes through, well then, we'll wait for the next zone, do the same thing. So now we're hedged. We're hedged at a $1,000 loss, and price can either go up back to this zone to retest that, or it can go down to retest this next zone. I'll show you what I do once price gets to one of these zones. Okay, so price got down here into this zone. It looks like I made it a little bit too thick. It looks like the zone was right there. So about halfway in is about right there. So about halfway into a zone, whatever I have, I'll do this one kind of quick. Let me go make sure. Yeah. So there's the highs and there's the closes down here. Yeah. So when price gets about halfway into a zone, just like on the first one, just like the second one down here, just like everything I've been doing, I'll close this sell in a profit. And then what I will do is I will add a buy. I will add to the losing trade. And I'll add at the same position size. And what this means is that, so we've had a profit on the sell going down. That's good. We have an open drawdown on the buy up here. And then we have another buy right here. Now, what this will mean is that if price goes down, I will close this in a small loss. And if price goes up, I will close everything in a net profit or break even, having also made profit on the sell. So we'll see if this goes up. And if it goes down, it's no problem. All I will do is I will close that second buy at a small loss. I will re-hedge the first position, and then I'll just let it keep going. So in this case, it doesn't go down. It bounced here at the second zone. Again, 50-50. The first trade worked. The second trade did not. The third trade did. I can almost feel like the fourth trade here might be a loser. I guess we'll find out, right? So let's do a little quick calculation of what happened. If we would have used a stop loss right here below this zone, that one would be a $1,000 loss. This winner would be a $1,000 profit. And you're off to the races with a net break even minus your brokerage commissions and swap fees. We can't have that. That wouldn't make any sense. We have to somehow make profit even when we're wrong. because you're just such a badass. People will be looking at you like, dude, did you see Jeremy last week, man? He was wrong like 3 times in a row, but he still somehow made money on that trade he took. People will be like, how the hell did that happen? What's Jeremy doing? Well, I don't know. Maybe Jeremy just has a real specific risk structure. And maybe Jeremy's alias is actually Nick Sean, and it's actually Nick Sean. Because I've made money for 15 months in a row up until last month. That was like my first losing month in 15 months. I'm kind of baffled I had a 15-month winning streak to begin with. But anyway, it's beside the point. So this pushed up here. And let's say once it got halfway in between both of the buy orders, we can close this buy, the bottom one, in profit. And then we can close this buy up here in loss. And since they're the same lot size and prices right in between both of them, they net out to be a net break even, because we had an equal distance of profit on that for the same lot size and an equal distance of loss on that one for the same lot size. So now what happened? Let's go ahead and calculate how much profit would be. So 50 pips was the amount of the distance from the entry to the area where we hedged. And again, that's called the invalidation zone. So it's 50 pips. So that means 50 pips for whatever this position size would have simply been $1,000 for every 50 pips of movement. So how much did this move from here down to here? Well, that moved about 98.5 pips. I'm going to be evil and round it to 100. It was double. Okay, sweet. So we made $2,000 on this sell trade going down here. Okay, sweet. So let's go ahead and add that in here. So we're going to add in the $2,000 profit from the sell hedge for when we were wrong about that first buy. The account's at $13,000. But wait, there's more. What about the buys? Well, keep in mind, we closed this one at a loss, and that one right about there would have probably been a little over $1,000, maybe like $1,500 loss. But then meanwhile, we've also got this buy here moving up, let's just say for simplicity, 75 pips. It moved up 75 pips. That's also a $1,500 profit. So if we calculate it out, it'll be 13,000 minus 1,500 plus 1,500. So those two buys cancel each other out and they're break even. So now we are completely out of what we call this basket of trades in a net profit, because we entered a buy, we were wrong, we hedged just below the zone, and then we waited for price to move to the next zone, we closed the hedge in profit, and then we entered another buy. And then when price pushed back up halfway in between the two buy positions, the second buy as well as the first entry, we just closed those at net break even. So we have a break even on the two trade, on at least the first buy that we were wrong about, and then we have a profit on the trade that we didn't even know was going to happen in the first place, but that sell hedge triggered and then went into profit. This is the beauty of simplicity. Just drawing support and resistance zones, buying and selling at them if they're a support or a resistance respectively. And if they're right, sweet. Take profits at a 1-to-1 risk reward ratio. That's all you need. You don't need a 1-to-69 or 1-to-6.9 or 1-to-0.69, because that would be less than a 1-to-1 and that wouldn't even make sense. It doesn't matter. You don't have to make it crazy complicated. Buy at support, sell at resistance. If they bounce into profit, take profit at around a 1-to-1. If they break the zones, enter a hedge, and then construct where the new zones are, because the price will be somewhere different. So just put the next zone above price, next zone below price, set 2 alerts, and then sit back and smoke some whatever it is that you like to smoke and wait for price to get to one of those 2 zones. When price gets to one of those 2 zones, simply manage the trade in the way that I showed right here. It's a very, very simple, straightforward way to profit, even when you're wrong, keeping things so stupidly simple that you're going to be really bored and almost second guessing and questioning, like, is this really all Nick does? He just goes to the daily chart and he draws these little stupid rectangular boxes he calls support resistance zones, and he just legit buys and sells with them. Y'all, I don't even wait for rejection most of the time. Most of the time I just literally enter as soon as it gets there. Why? Because I know what the metrics are. I know even if there is rejection, and even if the Forex God himself comes down from pip heaven and says, son, I think that I'm going to bounce right here at this zone, and I'm just letting you know so you can buy beforehand. Even if that happens, I would look the Forex God in the face and say, F you, bro, it's a 50% win rate, and I would still buy anyway before he'd even tell me that. He'd be coming down, and there'd be all the light. It'd be like the hallelujah and angels and stuff, and I would just be entering a buy anyway before he got there. And if he's like, I think I'm going to bounce here at this zone next. I'm going to say, bro, I already entered that trade like 5 minutes ago. You don't have to come down here and all this stuff with all these lights and stars and angels. It's good. I'm already in the trade. If it bounces, sweet. If it doesn't, I'll just hedge and I'll wait for the next zone. No problem. So with that being said, I think this should just wrap up the video here, to be honest. Let's see if we can get one more trade. So price comes back down here to the zone. So we can take the same trade again. We'll buy here. And in this case, the invalidation distance is 60 pips. So if it moves 60 pips into profit, then we will take profit on this next buy right here. And if it doesn't, we will get hedged and wait for the next zone. So it pushes up and then it pushes down and gets hedged. And I doubt that was 60 pips, 45 pips. So this one gets hedged. So perfect. Let's go, let's find the next zone. And we'll simply wait for price to get to the next zone. So the next zone I see is down here, a little ways down. So now that we've got this next zone, we can clear everything off because all you need is current market price and then a zone above and then a zone below. And then you just simply chill and wait. And you don't do anything until it gets to one of those zones. So it pushes back up here to this resistance. So here's what I would do in this case. In this case, I would just close the buy there at break even, and then I would retain the sell position. And then what I would do is I would hedge 60 pips above this zone because I would add an additional 1 unit of risk. So now instead of this sell is now in a $1,000 loss, the buy was break even. If it flips back around and bounces right there, sweet. I'll make profit on the sell, having had no additional risk except an extra $1,000 if price moved against me. So the sell would go, the buy would go right there, the hedge. So that way, if it breaks above the zone, we get hedged again. And then what do? We wait for the next zone and then keep managing the trade. Eventually, it'll bounce somewhere. And when it does, you'll roll out in profit most of the time. And if not, a break even another most of the time. And every now and then, I end up taking a loss. And when I do take a loss, it's a relatively big loss that wipes out a couple trades. And then I just do it all over again until it works because, eventually it'll bounce somewhere. So let's see what happens here. So price pushes up and it gets hedged again. So now we'll do the same thing, except now we're in a $2,000 loss right here. So this is hedged at a $2,000 loss. We'll simply look for the next zone above price and the next zone below price, and we'll wait for one of those zones. So the next zone above price is right here. And let me just kind of fine tune this just to make sure we're on the same page here. So about right there. So about halfway into the zone, I'll look to close this buy in profit and then enter a sell. So price goes to the next zone. So in fact, in order to not make things so hairy here, since we're in a $2,000 loss, what I'm going to do is I'm going to enter a sell right here. And I'm going to have a new dedicated invalidation zone just for this sell. And then for this specific situation, it looks like if price bounces here, it could go like a lot further down than a 1-to-1. So I'll just try to hold this for like a 1-to-2 risk to reward ratio. And if that happens, I can then close that in profit. That'll be $2,000 since it's $1,000 risk. And that also allows me to get out of this hedge at a break even because I had profit on the one that won. So this pushes above, it gets hedged. So now I'm hedged at a $3,000 loss. So it'll be fun. So keep in mind, we've made $3,000 profit so far. So now we're hedged at a $3,000 loss. It's no problem because this type of stuff will happen all the time. You simply sit back, you relax, and you wait for the next zone. So the next zone is all the way up here. Or this one right here, and we can take off that one because we don't need it anymore. So now what we'll do is we'll wait for price to move to this next zone up here or the next zone down here. And you just have to be patient. So price moves up to the next zone. So in this case, here's what I'll do. I will not screw around with this hedge as well because we really want to make sure that the risk structure is maintained. We will sell right here at this zone. We'll put an invalidation just above this zone, like right there, since the zone is nicely defined. And this is about how much? Like 56 pips. So that means if price moves down 150 pips, so roughly down to there, that'll be a 1-to-3 risk to reward ratio. And if that happens, then we can roll out of all of our previous losses at a break even. So let's see what happens. So price pushes above, narrowly misses the hedge order. Let's see what will end up happening here. So it goes up and it gets hedged yet again. So now we're in 4, well, technically 3. A $2,000 loss here, and then 2 $1,000 losses here. So this is a $4,000 hedged loss. Let's see what happens next. We're going to wait for the next zone, and we're going to do the same thing. I'm just marking up the next zone here. It's probably going to be this previous high. That's the only one that I'm going to do. So I'm just going to use that one, and then we're just going to chill. We're just going to wait for one of these zones to be hit. Okay, so price has come down to retest this current zone that we're at right here. So what I'm going to do now is I'm going to peel this off here. I'm going to set it the same distance lower, so that way, in case this breaks through and comes down again, we'll get hedged again, and this will be a $5,000 hedged loss. But eventually it'll bounce somewhere, and when it does, we'll be able to roll out of everything. So I'm closing this sell at break even, and I'm replacing it with a sell stop just under. That way, if it breaks back below, it'll just get us hedged again, and we'll just have to wait. So it does, in fact, break down below. So now we're hedged again, now at a $5,000 loss. So this $13,000 account is now at $8,000, $2K less than the starting balance. What do? The same damn thing. Simply wait for a zone. All right, perfect. So price gets down here into this zone. So here's what I'm going to do down at this zone. I'm going to enter a buy trade right here. And then all I'm going to do is simply wait for it to bounce. And if it bounces, that'll be great. If not, I'm going to get hedged underneath here at that location there. So this is about 65 pips. So if it moves up here, 230 pips, we'll calculate the profit. We'll try to take profit here at this next resistance zone. We'll see what happens. And it needs to go all the way up there for this to work. So it doesn't. It comes back down here and it gets hedged, now at a $6,000 loss. So one thing you have to be aware about is that there will still be statistical win streaks where zones just simply do not work. And when that happens, you continue to trade completely normally. So price comes back down here. And in this case, I would just simply close that buy at break even since it broke back above and just retested. So I'd close this buy at break even. And then what I would, hold the buy. I would close this sell. So I'd close this sell at a loss right there. Instead of doing all this, instead of messing with the hedge, let's just add another position here for a buy with the same invalidation just below. So like same distance. And it needs to go all the way to the resistance zone for this to actually work. Like a deeper test, yeah. Okay, so deeper test up to the zone. So let's calculate how much profit this was. We finally got a winner. So it's about, let's say a little under 50, a little more than 50 pips. We'll say 50 pips. And then if we close deep here into this resistance zone, that's about, so 250 pips is up here towards the top of it. Let's say 250. So this winner was 5 times what we risked, and we risked $1,000. So let's go ahead and roll out of that right there. And we'll say that was a $5,000 winner. So plus 5,000. And then what we'll do is we'll go back here and we'll see what all the losses totaled out to. So this was a $2,000 loss. So 3,000 for 5,000 and then a $6,000 loss. So in this case, minus $6,000. And this is $12,000. The account's at $12,000 now. So the fact that that losing streak happened, we were still able to roll out of it. And after everything, after all the consecutive back-to-back invalidations over and over, we were still able to roll out and almost break even. In this case, it was a small loss. This nightmare of like 1, 2, 3, 4, 5, 6 in a row invalidations, that type of nightmare rarely happens. From my statistical experience, it's about 1 out of every trade wins. So like one trade you win, the next trade you lose, the next trade you win, next trade you lose. Sometimes I have win streaks of 5 trades in a row. Sometimes I have lose streaks of 5 trades in a row. The point is if you continue to manage it in a contextually appropriate way, you simply enter at a zone, you hedge if you're wrong, wait for the next zone. You just keep doing this over and over and over. The idea is that eventually you will have a trade that wins, and when you do, you'll be able to profit from it. We'll take a last trade here. We'll say that we sold about halfway into this resistance zone up here. Looks like my Zoom session just ended on me, which is really weird. So we'll go ahead and just restart it here. And we'll take this last trade here. We'll see if it's the last trade, or otherwise we'll have to manage it and roll out of it. But that's okay, because it shows you guys exactly what I would do in, like, you know, real market scenario. So we'll sell up here at this zone. We'll have an invalidation just above this zone, above those highs. And we'll try to go for like at least a 1-to-1, if not maybe a little bit more. We'll see if it bounces. So a 1-to-1 would be, this is about a 90 pip risk for $1,000, and a 91 pip profit would be right there. I mean, that pretty much hit the profit target. Okay, if not, then it would have hit right there, and most of those days maybe closed a little bit more, a little bit less. It's around a 1-to-1, so it's about $1,000 winner. So this one wins $1,000, so we're plus 1,000. And now we're back to 13K, so we've made 13K on it. And remember, this is doing barely anything. This is if you started a 10K account. This is if you only, for some reason, just traded USD CHF, which you won't. You have all these other pairs you can trade with. You have like the 26 major FX pairs that you can trade. You get a couple setups a week. From my experience, I get maybe like 5 to 10 setups per week. And half of them win, the other half of them don't. I have to manage my way out of them. Sometimes it takes me 1, 2, 3 weeks to roll out of a trade. And sometimes I come out and profit or break even. That's what happens most of the time. Every now and then I come out in like a small loss or a big loss. You know, it is what it is. But overall, it's net profitable. This is with barely doing anything. Because keep in mind, this is a daily chart. This is with barely doing anything at all. This is just setting alerts at the major zones. And you can do this on any time frame. I like daily and 4-hour just because it gives me plenty of time to kind of see everything. The 2 trades you saw me take at the beginning of this call, GBP, JPY, and CAD CHF sells at resistance. I like it because it's just so straightforward and so simple, and they're pretty clearly defined, and they tend to get respected from my experience more than other stuff. So, I mean, that's how I do it. If you want to see me do this live every single day, the first link in the description will take you to my free Telegram channel. And in this channel, I just everything that I just showed you here. I just share what I'm looking to take. It's the same exact stuff I've showed you here in this call. Just I draw these little stupid gray boxes on my chart. And then if it's a resistance and price gets to it, I sell. And if it's a support and price gets to it, I buy. It's literally that straightforward. If you'd like to learn more, follow my free Telegram channel. It's the first link in the description. If you'd like to follow my trades or work with me and my team on a closer basis or get a full comprehensive course on exactly how I do this, that's the second link in the description. I'll take you to my website. You can check it out there. I have 3 products to help people learn how to trade. I've been happily doing this and sharing all my trades in my free Telegram channel for the past 5 years, and I'm loving it, loving every moment of it. Hopefully you can learn this now so you don't have to go through all the pain and suffering I went through for the first 2 years. Keeping things simple is the only way to go, in my opinion. There is no better way to trade than to look at a chart, barely have to do anything, and then consistently generate profits over time. Again, I can't guarantee you anything. I can only show you what's worked for me, and I have here in this video. I hope you enjoyed. And you don't have to subscribe or like the video or any of that shit. Just go test this trading system out and let me know how it works in the comments. Cheers.